Okay, thanks for hanging in there, everyone. Let's make a start. So today we're going to be talking about growing your mortgage brokering business with private lending. And my name is Tony Barbone. I'm one of the directors of Private Mortgages Australia. I've been in the private lending space since 2009, and PMA we set up in 2014. So we've got about 16 or so on staff. We work under an Australian financial services license, and we've just been growing from strength to strength over the years, and we're helping a lot of borrowers who can't get traditional finance, and we also help our referrers generate additional revenue for their businesses. So let's talk about that today. We'll jump straight in. We've got quite a fair bit to go through, so we're just going to power through it as fast as we can. Okay, so in today's sessions, we're going to talk about what are small business finance needs, how can a private lender help, who can a private lender help, how to increase revenue using private lending. We're going to sort of break that down for you so that you can see how it works. And of course, we're going to be looking at the PMA simple solutions for complex situations. And at the end there, we're going to be talking about the PMA Way. Not all private lenders are created equally, and we're going to go through what differentiates us from some of the other sharks that are out there. So let's jump straight into it, guys and gals. So small business finance needs. So we did a fair bit of research before we pulled this deck together, and one of the interesting statistics that we found is that 30% of brokers' customers are small business owners. Now, I'm going to say to you, I'm going to go out on a limb here and say, if you're a mortgage broker and you're only doing mum and dad vanilla type clients, I'm going to say you're doing yourself a bit of a disservice, because there's a real opportunity in finding business owners, small business owners, and being able to help them not only with their residential home mortgage or their investment portfolio, but also with their business, and that's what we're going to be talking about today. So, 50% of SMEs can't get finance. Now, this was actually COVID really shone a light on this over the last couple of years, and we were hearing that there's a lot of businesses needing to remain afloat, so they were trying to access this. I think it was like that the government subsidized business loans. But the problem that we heard all too often during this period was that the small business owners were waiting weeks just to get a response from the banks. And I guess the ultimate outcome from that is that a lot of small business owners now are they probably don't think that they're going to be able to get their finance needs met by the banks, so they're looking further afield. They're looking to other types of more flexible type of funding options available for their business. So another interesting stat that we found is that 43% of SMEs are expecting to borrow in 2022, which is a huge stat. If their business needs funding, they're going to look at borrowing it. Okay, huge opportunity for brokers to help their small business owner clients. Okay, and what we've seen through our interest rates, obviously. They're looking for speed of access to funding, but they're also looking for flexibility. Okay. Now, we think that using private lending as another tool in your toolbox is going to be a really great way for you to sort of round out your offerings and be able to help more people that are really looking, that are going. And there's a lot of small business owners that are going through challenging times at the moment, and we want to arm you with all of the tools so that you can go out there and really help as many clients as possible. Okay, so how can a private lender help? Well, I'm going to dial it back a little bit here, and what I want to do is, obviously it's when a bank says no, but what I want to do is I really want to define what I would call the traditional lender camp. So once you understand the traditional lender camp, then you can understand the private lending camp. So let's talk about the traditional lender camp. I would say that you've got your big banks, your little banks, and your non-bank institutions like your Pepper and your Latrobes and your Liberties of this world. Now, the reason why they comprise that they all make up what I would call the traditional lender camp. Now, the reason why, once you've actually understand that they're in the traditional lender camp, then you can understand the private lending camp, which is everyone else. okay? All of the other private lenders that are out there. So the reason why these large institutions, the way they raise their money is through using what's called a securitization warehouse. Now that goes well far beyond the scope of this webinar topic today. But basically, once you start raising billions of dollars, you start going for scale. Now, once you go for scale, you lose flexibility. That is the trade-off. Now, where private lenders come in is that they're out there. We can provide flexibility. Okay, we don't have billions of dollars under management, unlike these larger traditional, what I would call traditional lenders. So private lenders are the camp that can really provide that tailored, more flexible type of solution to your business borrowers. Okay, and one of the big differentiators is serviceability. Okay, so in order to get that money that's inside these big securitization warehouses that are very competitive rates, the first thing that they're going to look at is serviceability. They have to prove that the borrower can make these ongoing interest payments for the next 25 years. Okay, whereas as private lenders, we're not looking at long-term serviceability requirements because the loans are short-term in nature. We're only providing credit for a period of 3 to 36 months. Our average loan is 8 months. Okay, so we're not looking at serviceability. We're looking at the borrower's exit strategy. How are they intending to repay the loan in a relatively short period of time? Okay, so other things that we can help borrowers that have credit blemishes. Okay, we live in the real world. We understand that things happen. People go through hard times sometimes. But as long as they're proving that they're showing that they're getting things back on track, that's okay. We can look past that and we can provide them a short-term solution for them before they can get back into the traditional camp again. Okay, so all of our loans come with prepaid or capitalized interest, and they also come with monthly extensions. Okay, so I'll give you an example. A typical loan for us might be like 6 months prepaid, where the borrower doesn't have to make any payments for 6 months, and then 6 monthly extensions. We live in the real world. Sometimes settlements get delayed, and so obviously the borrower is able to pay 1 month in advance, just for 1 month at a time until the refinance comes through or the exit strategy comes through. Now, if you as a referrer can fill out our online quick app, which takes less than 10 minutes to fill out, the borrower your client doesn't need to sign that at all. If you submit a quick app to us, we have a 4-hour response guarantee. That is 4 business hours. We'll get back to you, and we think that's perhaps one of the fastest in Australia. And of course, we can look at doing settlement within 5 days, as opposed to sometimes waiting 5 weeks for a letter of offer from a traditional lender. So let's keep on moving. I've noticed a lot of comments flowing through on the and questions here. So we've got definitely we're going to get the slides out too. But what I'll do is if we've got some time at the end, we'll take questions at the end. So I'm acknowledging that they're coming through, and that's great. If we've got some time at the end, we'll look at those questions. So who can private lenders help? So obviously, we can only do non-coded lending. So that's any genuine business purpose. So if someone's just set up their ABN yesterday and they've got a business plan and they're just getting started, that's fine. We can help. They don't have to have 6 months or 2 years of trading financials for us to look at them. We help business owners all the time, property investors and developers. Any business borrower looking for urgent funding. So, we see this all the time. Sometimes they've got an upcoming property purchase, and the bank, the funding that they thought they had, the bank has just changed their lending policy, and they've just said, no, we're not going to lend in that postcode anymore. So we have to scramble. The borrower's in a frantic state. They contact their referrer and they go, well, help me, I've got to settle next week, otherwise I'll lose my deposit. And all of the work I've been doing on this project for a little while. So we can help in those urgent funding situations. Mortgagee in possession, we see that a fair bit, which the bank's about to take possession of the property and sell it. They're about to appoint an agent. We can provide a letter of offer in a relative, very quick period of time, and we can get them out of a jam. So obviously we've been through no serviceability. Credit impairment, cash flow issues. We see that all the time. There's sometimes you've just got seasonal businesses, but more often than not, in recent times, we've seen a lot of small businesses that have been affected by the pandemic, and they just need some working capital to see them through a hard period, through they're in a jam and they need working capital to see them through for the next little while. Businesses with ATO debts. Now, the ATO, they want their pound of flesh. What we've noticed is that the ATO will typically only grant one payment plan at a time. So, and as soon as someone goes and applies for 2 payment plans at once, the ATO usually says no. They're not going to provide any more credit to the business, and they want their money back by a certain deadline. Okay, and in these situations, you don't want to mess with the ATO. You don't want them breathing down your neck. So we can come in and we can provide a short-term finance solution and help them out. Loans based on valuation, not contract price, obviously, and borrowers paying out their business partners. Sometimes it has to happen rapidly if there's a deterioration of a business relationship, and sometimes it's like, well, you know what, I've got an opportunity here. I can buy out my business partner. I can take over. I'm just going to put some property up as security, and I'm going to get it done, and the business will be mine. I'll get 100% of the profits moving forward, and with the business. So what I want to really point out here as a referrer, what I really want you guys to sort of take home from this webinar is that business borrowers are either moving away from pain or towards pleasure. Okay, it really boils down to that. And if you're not asking your business clients, what are your challenges that you're facing, or what are your upcoming opportunities, you might really want to try that on and just see how successful you are with that. Just asking those 2 very, very simple questions. What challenges are you currently facing, and what opportunities do you have coming up? This is the kind of language that small business owners speak in, and I think it would really resonate if you can ask these kind of like really great probing questions without if they want, hopefully they can share with you, and you're someone that they can speak to about their plans. So these are the kinds of conversations that you want to start having with your small business owner clients to really flesh out these opportunities. So let's talk about how to increasing revenue with private lending. So many residential clients that you have on your books are also small business owners, according to that statistic of 30% that we covered in the previous slide. Private lending is about understanding your client's situation. So I'm going to hammer this point home, guys. They're either moving away from pain or they're moving towards pleasure. Either they got like an ATO debt, they have to pay it next week, or they're going to settle on this property next week. Otherwise, they're going to lose their deposit. That's a pretty big pain point, okay? Or they're doing a development because, they want to make an extra $1 million over the next 2 years, okay? So, they're going to be really falling in one of 2 camps, and they're very immediate needs. That's another phrase I really want to sort of drill home, is that private lending, that usually what you're going to find is that your clients have an immediate need, okay? Now, is there an opportunity to help them? If you're asking the right questions, what are your current challenges? What are your upcoming opportunities? You're going to really flesh out these types of scenarios. Okay, we've discussed their needs and goals. And another item I really want to talk about is that, if you are bogged down writing business for your residential vanilla type clients, and I understand that's very time consuming with all the current legislation that's in place, and you don't have a lot of time to sort of, hold your client's hand through a private lending transaction, that's fine. All you need to do is identify the opportunity. We would prefer it if you got a mandate, and if you after a mandate, we've got a template on our website of a mandate that you can use. If you don't have a mandate, that's fine. You can we know that the client will come from you, and that's always going to be your client. And you can send them our way. We will do everything. Our relationship management team will handle the transaction from start to finish, and all you'll need to do is just send us through an invoice. Okay. Now, and of course, once you've identified the opportunity, you understand that they can't get funding through traditional means, through that traditional lending camp, and they need a private lending solution to move forward with their plans. Send them our way, and then when they're ready, you can then refinance them back into the traditional lending camp. Okay, so you really get 2 bites of the cherry. Okay, so this is another a real benefit working with great. We love to work with great referrers that just get it. Okay, so let's have we want to really sort of drill down and sort of the headline is how to increase your revenue by 30 to 50%. And look, we think this is conservative, and it would take a little bit of work, and but this is the way that we look at it. Just really from just a nuts and bolts type of, this is how you're going to do it. So if the average, according to the Monarch Institute, the average broker revenue is around $100,000 per annum. Okay. Now let's assume that we've had to make some assumptions here in coming up with these calculations, but let's just assume that you've got 120 clients on your database. Okay. Now let's assume that 30% of those clients are your small to medium-sized enterprises. Now that shows us a potential of 36 client scenarios. Okay. See how it's important to get in front of them and start asking them, what are your challenges? What are your upcoming opportunities? Okay. Now, assume 10% of those have an immediate finance scenario, okay, during the year. Let's round it down to 3. Now, our average loan size is $1 million. Now, let's say that's $3 million in loan volume for the year that you refer to PMA. A mandate fee of 1% plus a referral fee of 1% is equal to $20,000 per client scenario. If you get 3 of those, it's $60,000 in additional fees each year, or call it 60% increase in revenue, in top line revenue. Now, let's be conservative. If you only get 2 client scenarios settled in a financial year, that's still 40% increase, or $40,000 additional revenue for your business. Now, do you think it might be worth asking 36 of your clients if they have an immediate finance need? Do you think it might be worth asking your SME clients if they have, what are their challenges and what are their upcoming opportunities? Probably, I would say so. I think it's worth asking 36 questions along those lines. So it's complicated, but it's not. And we're making it as easy as possible for you to get, so that when you're out there asking these questions and these probing questions of your SME clients, that you know that you have a solution in your back pocket, okay? These are PMA solutions. We've whittled this down over many years of trial and error. We're taking the guesswork out, and this is what we're good at, and we just leave everything else to everyone else. And the things we don't do are like things like caveat loans. The 24-hour guys paying 4% per calendar month for money. We don't do that stuff. We're not the 24-hour guys. This is what we do really well, and we just focus on this little niche in the marketplace. Okay, and we just want to work with great referrers that get it. Okay, so bridging or working capital solution, just needing access to working capital if they've had a downturn in terms of revenue. Business purchase or establishment, like I said, 24-hour ABN is okay by us as long as they have a genuine business purpose. If their intention is to establish a new business, that's fine. They don't need trading financials to get funding from us. Business equipment purchase, of course, I just want to clarify, we don't do asset finance. We don't just lend solely on the business asset. We require real estate security. Hence the mortgages in private mortgages in Australia. Equity release, first and second mortgages, and refinancing existing loans, existing private loans. We've got no problems with refinancing existing private loans, doing debt consolidation. Obviously, ATO debts that we've harped on about that. I hope that you guys can remember that you got that one in your back pocket. Now, a lot of this stuff, if you look on the business solution side, that's really the pain points. What are your current challenges? Geez, I've got this like ATO debt coming up. I'm going to need access to a couple of $100,000 real quick. Sure, we can help you with that. No problems. Property solutions. This is your they're moving towards pleasure. You know what? Things are doing good. I'm about to, business is going well. I'm dabbling in, I've got this upcoming project. I'm going to put 3 townhouses in, blah, 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 blah. Wonderful. You've got to acquire the land. You've got to have, you've got to do the construction funding. There's a lot of opportunities for you. If you can identify an upcoming opportunity for your business client, there's a lot of ways that you can help one of them moving into the development space. We love to call them budding developers. Okay, they're usually they're not a full-time developer. They've usually got, this is just another way of them investing, but there's a little bit more hands-on. They have a bit more control over it. So yeah, these are the different solutions we can do. Obviously, the acquisition of land property finance, the land subdivision, when you're cutting up a block into smaller blocks. Renovation, we've done a heap of these ones. Renovation finance, where we lend on we help them acquire the property, and then we lend on the end value as well. Okay, yeah, there's quite a bit of work involved with that, but we've got some wonderful sponsors that we work with on a regular, ongoing basis with that. The development construction, larger projects that typically go for sort of longer than 12 months. Construction completion, we see this all the time where someone's gone and borrowed money from the bank to construct a project. There's maybe been a cost blowout. We're seeing a lot of rising costs in materials over the last sort of 18 months. Let's say their contingency has been blown out and they need access to a certain amount of money for a few months just to complete the project. Okay, so we can do that. We can actually put a second mortgage on the project itself and help them complete the project. Mezzanine finance, which is sort of same as it's a second mortgage essentially, but it's done at the start of the project, not at the end of the project. And of course, residual stock. Let's say they haven't. You just might have a few leftover apartments in a block of apartments. We can help with looking at doing some longer term finance for that. We don't look at things like serviceability. I understand that other lenders out there, yes, they have a very attractive rate, but they're only doing around a 1.2% debt cover, which usually translates into about a 55% LVR. Okay, so if you have a borrower that wants to access like up to 75% LVR without financials on some leftover stock from a development, yeah, we can certainly look at that. Okay, and prepay the loan, they don't have any payments, they can pull that equity out and they can pump that into their next project. Okay. So PMA's pricing terms and LVR. So we've got rates starting from 4.75% per annum. That does exclude our management fee. Okay. Loan amounts from 100,000 to 5 million. This is just our sweet spot. Our average loan is around about $1 million. That's just a little. We like playing in that space. And our loans are sort of from 3 to 36 months. Average loans around about 8 months, and we do first and second mortgage security and loans up to 75% LVR. It really depends on where the property is located and what it is. Okay, if someone's looking to put in a high-rise apartment complex out in the middle of nowhere, maybe that opportunity is not for us. But if they're looking for 75% LVR on a major metro residential property in suburbia, that's fine. We can look at that sort of thing, not a problem. So this is our lending process. We have over the years whittled it down to be as simple and easy as possible. So we have an online quick app, which takes less than, I think we timed, I think it's about 8 minutes to complete our quick app. And all it does is really just pulls all of the really high level information that we need. That your client doesn't need to sign it. You submit it, we receive it. If you've submitted the quick app, we guarantee to have a response to you within 4 business hours, probably the fastest in Australia. And we'll either send you an indicative letter of offer or we'll send you through a quote if we haven't quite got all of the information that we need. The borrower, your client, doesn't need to sign anything until we issue the indicative letter of offer, and that's when we do all the privacy declarations at the same time. So it's all sort of tied up together. Once we get the indicative letter of offer in, we do our due diligence, and then once our due diligence is all been approved, then we'll move to our letter of offer, and then we move to settlement. It's pretty straightforward. So let's have a look at some case studies. Just a second, guys. So case study, where this one here is a land property finance. So, and this is a little bit of a curly one, and this is the type of thing that we see all the time. If you can't get funding from the traditional camp for whatever reason, you come to us. If someone says, hey, if you come to us and say, oh, I can get 5% per annum from La Trobe, we'll say, great, go with that. Why are you bringing it to us? Sorry to be blunt, but we're really there to provide solutions where traditional lenders can't. Okay, so try the traditional lenders. If they can't provide, if they tell you it's a no and they explain the reason why, then we can have a look at it. So this is an experienced property investor purchasing, and this property investor specializes in like rooming houses. So they put, they're sort of like, I don't know if you've seen them, but they're rooming houses. So you have like a tiny little sort of like a little studio apartment, but you might have 5 or 6 of them on a residential block. And anyway, this is their new project that they're doing, and they're just short of 400K. So in this occasion, they said he was going to be using his mother's unencumbered property, and so we're like, well, we can't take third-party security unless, of course, you can prove that there's a commercial benefit. So their solicitor and accountants provided us with the documentation showing that, yeah, okay, once the actual the development has been done, then the mum is getting a unit in the project. Okay, so we're like, well, that's a clear commercial benefit. The solicitor's seen it, the accountant's seen it. It's all above board. It's legit. It's real. We verified it. So yes, on this occasion, we can take on third-party security. I just want to clarify, we normally don't take third-party security. We have to prove that there's some sort of commercial benefit that we can verify. Okay, they were able to verify it. The exit strategy, obviously, once all of the construction's done, they're going to refinance it. So security property, value of 1.2 million. We put a first mortgage on there for 451,000. Very low LVR, and we did that one at an interest rate of 5.56% plus our management fee. 12-month prepaid term, no monthly interest payments for 12 months. And then, the plan is the exit strategy will take us out, but we live in the real world. Sometimes there's delays, so we build in some extension payments, monthly extensions, for them to, if they require it. So that's one case study. We've got another case study here. So this one is land subdivision. So this is one of our repeat clients. They're looking to do another land subdivision in Trinity Beach, which is up in Cairns. They can't get bank finance because they're maxed out. Wherever they can get bank finance, they'll get it because it's going to be obviously more cost effective than a private loan. But sometimes the banks impose sort of limits on how much they'll lend to the sponsor or the borrower. And so this is one of those situations where they've identified a property for sale on 1 hectare residential property, has an existing house on there. They knew that these people they love doing they do subdivisions. We've funded their subdivisions in the past. They're really good at it. They know that there's money in this project, so they knew that, okay, well, what we'll do is we'll acquire the property. We just want to acquire. Basically, it was just the funding to acquire it. Okay, so we provided them 70% LVR, and they and they were going to self-fund the subdivision themselves. Okay, and so they know that they could. The property had already had the development approval in place for the two additional lots. There's money in it. They're doing the project now. They're self-funding that one, and I think the titles. I think we just got notice that the titles have just been accepted through council. So we're probably getting very close for that one to be repaid. So that's another example of one that we can do. And we do see, and as I mentioned there, we have a repeat client. So we get a lot of repeat clients. So we think we're doing something right when people keep coming back to us again and again. If they get it and they understand, I'm going to pay a premium for the money, but I'm still going to make, X amount of hundreds of thousands of dollars on the project. Oh, all right, that makes sense to me. So it's sort of, like I said, they're usually moving away from pain or towards pleasure. Okay, so and it really boils down to, it just comes down to a numbers game. If they go, okay, well, if I'm going to do this project and it's going to cost me $100,000 in financing costs for 6 months, I can live with that because I know I'm still going to make $300,000 profit on it. It's a simple thing. Whereas the bank's already told me no. So it's an easy conversation to have. It's not all about the interest rate. Okay, I know. As brokers, you probably had, you're out there on the hunt for the best interest rate for your customer. And I totally get that. I totally understand that. And that's what you've got your traditional camp for. You play them off against each other to get the best rate. But when the traditional camp says no, and they need a solution, come to us. But the conversation's not going to be about the interest rate. The conversation is about, do you want to move forward with your plans? Yes, great, here's a solution. That's it. It's as simple as that. They can do the cost-benefit analysis themselves. So here's our fees and charges. It's all scaled. I don't really need to go through that in great detail. It's very self-explanatory. The referrer fee is payable to you as the referrer. Look, you don't have to be a mortgage broker to do business with us as well. We have a lot of people that send us opportunities that aren't mortgage brokers, and we call them. That's why we call them referrers. So this is what we pay for all of our opportunities. Now, I've got here, you'll see the little point that it says service fee. So if you want to, you can mandate your client, and we have a draft mandate template on our website if you're interested, or you might have your own. We prefer if you mandate your client, because it shows some commitment, that shows that they're serious about acquiring the finance that they've said that they need. If you do have a mandate, we'll pay whatever it is if you've managed to mandate for 2%. That's not a problem at all. We'll just put the mandate, we'll need a copy of your mandate as soon as you send us through the quick app. And what we'll do is we'll put the mandate in the offer. So it's all clear and disclosed. Now, if you don't have a mandate and you want to make some additional revenue from the transaction, we can put a service fee in there for up to 1%. A lot of the times, a lot of the referrers that we work with, they're just happy with the referrer fee. Okay, they don't want to crash the deal because there's way too many fees. So it's a bit of a balancing act. Okay, in terms of the assessment fee, so it's $1,000 upon acceptance of the indicative letter of offer, and that's really for us to cover all of our due diligence. Okay, so we've got numerous searches that we have to conduct. There's quite a lot of work involved on our part, so we just need to obviously receive the upfront assessment fee. Any valuation or QS fee, that's all done at cost and on a flow-through basis. Now, the only other, we do have a typo here, the legal fees, that actually, upon acceptance of our formal letter of offer, there's actually a fee of $1,100 payable to our solicitor. And that's not paid to us, it's paid directly to our solicitors to prepare the loan documentation. Okay, so they're really all of the out-of-pocket expenses. And when I say valuation at cost if required, and the same with the QS fee, it's because we don't always require it. So we have a very flexible valuation policy, and we can accept valuations from other instructed by other lending institutions that have been instructed for mortgagee purposes that are less than 6 months old, I think it is. So we can lend on existing valuations, but we just want to verify with local real estate agents if the valuation is on par. What we're really looking for is just consistency. So we do desktop valuations, local agent appraisals, and actual formal valuations. So yeah, we've got a fairly, I would say, a very broad valuation policy. Okay, so we don't always have to, your client doesn't always necessarily have to pay for a valuation report. Okay, and that's very helpful, especially if it's a very urgent situation. Okay, so doing a development's a very different story. That's a very specialized valuation report we will require. Same with the QS report. But just if in terms of it's just a short-term loan for a business solution, yeah, a lot of the time we don't require a formal valuation. So working with our referrers, so over 90% of our business comes from our referrers, and we want to keep it that way. Okay, if you don't have time to hold your client's hand from start to finish, we'll do it for you, and you still get paid. Okay, as I mentioned in the previous slide, you can either put a service fee in for up to 1% of the loan amount, or you can mandate your client directly for more than that, but then we just pull the service fee out and put the mandate in there directly into the letter of offer. So everything's very clear, it's all disclosed, and there's no misunderstandings between us, yourselves, and the borrower. Okay, so it's all very clear. We paid the referral fee on settlement. There's no clawbacks, which is great. We've also got a subsequent referral fee program in place. So, and we find this works really well. So because we have regular repeat clients. So if a client comes to us via a referrer in the first instance, and then the client comes back again for a subsequent loan, we will do all of the work, and we'll just pay the referrer the referral fee. Obviously, if we have there's a few terms and conditions around that. If the borrower goes to a different referrer and signs a different referrer's mandate, well, we have to honour the mandate that's in place. That's the wishes of the borrower. That's why we always insist, please get a mandate if you can. It locks in your client, and it really cuts out through any confusion around fees. It really helps with the transparency piece. And if we had dealt with that same client and it come through a different referrer, we have to honour the client's new wishes, which is if there's a fresh mandate, we have to honour that. Okay, and of course, when we provided the private lending solution to your client, at the end of that, you get to refinance them back into the traditional lender camp if that's what it's required. A lot of the time the exit strategy is going to be either like a sale of a property or a refinance. And sometimes the reason why they can't get a refinance from a traditional lender is because the accountant hasn't got their financials up to date. So once they've got all their ducks lined up and they can go back into the traditional lending camp, you get the second bite of the cherry as the referrer. Okay. So how do we look at opportunities? So they need to, this is what we call the first filter or our initial assessment. And as referrers, we would ask that you guys really understand this, so you're going to just save everyone time, especially yourselves. First thing we don't do is we don't do any coded loans. Okay, we don't have a consumer credit license, nor do we ever intend to get one. We've decided to niche down into the commercial credit space, and so each loan has to be non-coded or genuine business purpose or a company borrower or a company trust structure. Company borrower or company trust structure, they're automatically deemed to be non-coded. Okay, we've got rates from 4.75% per annum. Obviously, that excludes our management fee and the postcode and LVR. If they're looking for an 80% loan in a Category 4 location in Whoop Whoop, that's probably not going to work for us. 80% on a rural property isn't going to work. But hey, look, if they're looking for sort of 50% LVR on a rural property, yeah, we could probably look at that. It just needs to make sense. The exit strategy is very important to us because we're not looking at the serviceability like a traditional lender. Okay, we're looking at an exit strategy. How does the borrower intend to repay the loan in a relatively short period of time? That's what we need documented evidence of. Why can't they get bank finance, or why can't they get traditional finance? That's pretty self-explanatory. If a borrower, if you come to us and say, hey, Pep is going to do this one at 6% per annum, can you beat it? I'm like, no, go with Pepper. I hate to be sort of blunt on this point, but if you're doing that, you don't really get where private lending fits in. It's if the traditional camp can't provide a solution to your customer. It's as simple as that. And when do they need to settle? We get faced with urgent settlement situations all the time. Yes, we can settle within 5 days. No, we don't always need valuations, but we can only move as fast as a cooperative borrower. Okay, if it's urgent, we need to know it's urgent from the outset. And we can't have someone dragging their feet. If we're waiting on documentation, that's really not our fault. You as the referrer need to sort of either control your client, or if you've said, yeah, no, we want you guys to handle everything, you just got to make sure that the borrower is prepared to accept the call from us, and we'll hold their hand through that process. Now, we're doing pretty good for time, so we should probably have some time to do some questions. So if you have questions, load them up. I'll get to them after this slide here. So the PMA way, as I mentioned at the start of the presentation, not all private lenders are created equally. Let's talk about why. So when my business partner and I, we set up Private Mortgages Australia in 2014, we had our vision was to really create a private lending company that sort of took the other mortgage management business and sort of turned it on its head. So we just want to be really transparent. We just wanted everything to work really simple. We think that a lot of others in the marketplace just overcomplicate things, or they have some shady tricks that they try to use to catch people out. And I'm going to sort of reveal a few of those shady tricks to you now. So we have low upfront assessment fees. I've seen time and time again other private lenders charging tens of thousands of dollars in upfront fees before they do anything. And a lot of the time they just call these valuation, you can't see me, but I'm doing air quotations, valuation fees. And what they do is they instruct the valuer to go out there and kick the value in the guts and do a forced sale valuation. And then it comes back with this super low LV, like these super low values, and they'll only lend like 65% of that value. And it's just, a lot of the time it doesn't stack up, and they've just pocketed, tens of thousands of dollars for that situation. So, we don't like that. We call those dirty loans. And I could probably do a whole webinar just on dirty loans, but I just wanted to go through it very quickly here. So what we don't do is we don't have charging clauses in our indicative letter. What a charging clause is it allows a lender to caveat other properties owned by the borrower. Okay. This is one of those dirty tactics that we're talking about. The cancellation fees. Some lenders, they say sign our indicative letter of offer. It might have a rate from 1% on it. And then what they do is they do all of their work and they instruct their solicitor to prepare the loan documentation. But then the loan documents come back and it's like 3% per calendar month. And the borrower's sitting there going, oh my God, I've got to pay what? 3% per annum? It's in the loan docs. And they say, well, I'm not paying 3%. It said 1% from 1% in the indicative letter of offer. And they've said, oh yeah, well, that's what we deem level to be at. And because we've instructed our solicitors, or now we're going to put caveats all over your properties and we're going to charge you a cancellation fee. And what they do is they basically hold the borrower's real estate to ransom until their fees are paid. So we don't do any of that. We don't like that. We try to explain to people, look out for these things. Valuations are done, our valuations that we instruct are done on a flow-through basis. So we send through the quote, any margin on the valuation, and we ask the borrowers to pay the valuer directly or pay to us, and we remit it to the valuer. And it's done for a reasonable value. We instruct for mortgagee security purposes. Or in some cases, we don't require a valuation at all. Our legal fees are all done at cost on a flow-through basis. And in terms of the actual loan itself, once, most of our loans, I'll give you an example of a typical loan. Typical loan is 6 months prepaid with, say, 6 monthly extensions. Let's say the borrower, finalizes the 6 months prepaid period, and then they go, well, my settlement got delayed by a month, so I'm going to give you guys notice of me getting paid out. I'll pay it out in a month's time. Here's my notice for that, and I'm going to pay 1 month's interest in advance. And then 2 weeks later, something happens, and then they, the settlement gets brought forward, and so then they pay us out. So because they've given us notice and because they didn't use up all of their interest for that month, we will rebate that. Okay, it doesn't apply in the prepaid period because it's fixed, a bit like a fixed loan from the bank. But in that ongoing period, yes, we can provide rebates in terms of interest. We've also got custom-built software for faster deal processing times, as you can see with our 4-hour response guarantee. And we have a high level of repeat customers, but we've also got a high level of repeat refers. We seem to be doing something right because we keep getting refers coming back and back again. Okay, and what we call this is a win-win approach to lending. So, look, that is it. Thanks for hanging on and getting through it all with us. We got there. Now I put through the details here of Shanta Lobo, our general manager of relationships. Now, this is her contact details. She's a gun. She's a banking executive of 20 plus years, and she's been with us for quite a long time. She handles all of our quoting, so she's the best person to reach out to with a specific scenario. So be sure to jot down her details. And what I'm going to do now is I'm just going to go through and I'm going to start going through some of the questions. If you have any other questions, please pop them in, and yeah, we'll be sort of wrapping up pretty soon. So I've got a question here. Can this product also work as bridging finance? Yeah, absolutely. So, bridging finance, of course, we can do bridging finance provided it's for non-coded purposes. So if someone's just selling their home and they are buying another home and they just need a short-term loan to move, in between, to help with those settlements, no, we can't do that. If they're living in the home, or if it's an investment. If it's for residential investment purposes, that's considered a coded loan, and we can't help in those situations. So, yes, we can do short-term bridging finance, provided it's a non-coded loan. So either it has to be for a genuine business purpose, or it's a company borrower or a company trust borrower. And if it's a company borrower, company trust borrower, then it's automatically considered to be a non-coded loan. Okay. So I think I've answered that question for the bridging finance around residential lending. Oh, and it's okay. Look, I just want to clarify a couple of points about that residential lending. So we can't provide finance if it's someone's home or a residential investment property. Now it's okay. I just want to clarify here. So if it's just a borrower and it's a company borrower and they're buying a property in there, like as a guarantee, if they're trying to buy a property and just tie up a company to become the borrower of the loan, we can't help in those situations. The company has to actually be buying a property and becoming the owner of the property. It has to be genuine. It can't just be sort of like synthetic looking. So yeah, we've got some advice from our solicitors on that. We can't help in those situations where they're just trying to make it look like a non-coded loan. It has to be a genuine non-coded loan. So let's have a look here. So the owner builder doing own build project. So yeah, we can look at owner builders, of course. It has to be non-coded. We have to use a quantity surveyor. So making sure that we have someone independent that can go out there and actually cost up the project and ensure that all of the progress drawdowns are being done correctly. So that's not a problem at all. What's the maximum size of the property? Do you accept farms? Yeah, we do actually. It depends on where it is and what it is. We don't really have an upper limit to the size of the land, but it just needs to make sense. If it's 1,000 hectares in far north Queensland, we might not be too interested in that one. But we are looking at a vineyard down in Tasmania at the moment as one. I think that's on a couple of 100 acres, something like that. So it just depends on where it is. We've got a really good because we use Optium as one of our valuers, so we've got really good coverage, national coverage, as well. We've got quite a few national valuers. But if it's something complicated like rural land, we're probably going to need a valuer out there on those situations. We have a bit more discretion over requiring a valuation report if it's like in a homogenous major metro residential area. If it's a house in suburbia, and we kind of know what houses in suburbia go for, then that's pretty simple. We can use our online valuations and our local agent appraisals. But something very complicated like hundreds of acres, we're probably going to need a valuer to go out there and really have a good close look at it for us. But there isn't really any maximum size. But we do only have a limit of around $5 million on a maximum loan size. So that might have a little bit of a collar on how much we can do. I've got that question here. Just that owner builder doing own project, would you look at, yes, I've mentioned the owner builder piece, but then I missed this little bit down here. How do you assess serviceability? We never assess serviceability. We never assess serviceability. It's a non-coded loan. We don't look at whether or not the borrower can afford the interest payments because the money is just for a short period of time. Okay, usually 3 to 12 months. Our average loan is 8 months. They have to have an exit strategy. Got to look at it a little bit differently to the traditional financiers who first thing they look at is serviceability. Secondly, the value of the property. We look firstly at the value of the property and secondly at the exit strategy. Okay. Guys, if you haven't, please complete our poll that we put forward, and we've also got a free guide to private lending in the handouts section. And yeah, everyone will be getting a copy of the slides who has attended, so we'll send those through. Yeah, and look, I think that's kind of refinance existing development finance in the middle of construction. Thanks, Leo, for your question. Guys, if you've got any other questions, please pop them through. I can field it for a little bit longer, but we're about to wrap up. So, refinance existing development finance in the middle of construction. Yeah, potentially. Sometimes what we do is we just do construction completion finance. So if there's a situation where funding a project and there's been a cost blowout, and the senior lender doesn't really want to provide any more additional funding to the project, what we can sometimes do is we can go in there and we can put a second mortgage on the back of the existing first mortgage that's there, provide the extra cash needed, and that's just for a short period of time until the project finishes, and then they can start selling it down. So yeah, if you've got a scenario around development finance and in the middle of construction, we're not going to say no, but we are going to say we have to have a closer look at it before we agree to do it though. But yeah, we've done plenty of those in the past. So yeah, feel free to shoot Shanta an email or give her a call, and you guys can talk a little bit more in a bit more detail about that. Yeah, I think we'll make a note of sending it through a copy of the mandate as well when we send out the slides. It's a great note there, Jay. We'll definitely do that. That's it, guys. So look, thanks everyone for hanging in there. Appreciate your time. And yeah, if you have any questions in relation to any specific needs for your customers or your clients, please send them through to Shanta. Thanks again for tuning in, guys. Have a good one. Bye.